How's everyone doing? Okay. I know that there's a bunch of conversations going on. If we could move towards the back of the stage so we can get going with the next one. Because we're about to find out, are VCs still investing in crypto in this market, in this economy? And I've got Mickey moderating this panel. I will leave it to him to do the round of intros, and we'll take it from there. All right. Folks, if you don't mind taking a seat or moving the conversation to the side of the stage, please.
Okay, great. Thank you. Mic check. Everything sounds good. Awesome. Well, thank you for joining us. Hello, everyone. My name is Mickey Graham. I am a co-founder and general partner at MetaLayer. We are a $25 million early stage venture fund focused on the intersection of traditional financial services and the on-chain economy. With me, I have three really incredible funds represented, Maven 11, CMT, and HiveMind, some really, really great early stage investors that I know are very active in this environment, in this market. So I'm looking forward to spending 20 minutes kind of picking their brain on what they're excited about, what they're seeing, what their sentiment is. But maybe before we jump into all of that, can I just have you three introduce yourselves?
Should I start then?
Yeah,
okay.
Sure.
I'm Alexander. I work at Maven 11. We're a crypto-only venture fund based out of Amsterdam. We've been investing in the space since around 2017. We're currently deploying out of our third fund. It's a $110 million vehicle. And we've always sort of focused throughout the three vintages in early stage companies, so that pre-seed to seed stage companies. But we've done a couple of Series A's here and there. On a personal level, I've been in crypto since 2017. I guess I fell down the crypto rabbit hole during the ICO boom back then. I was still at university. I got nerd sniped pretty hard, I guess, like many of us here. But yeah, so I've been working at Maven for the last 2 years and focused more on sort of the on-chain DeFi side of things. But yeah, I'll keep it at that.
Hey, everybody. It's great to be here. My name is Kayla Phillips, and I'm a VC at HiveMind Capital. HiveMind is a crypto asset manager. We have been around for about 4.5 years now, and we're a multi-strat firm, so we invest across venture, liquid tokens, public equities, and NFTs. On the venture side, we are actively deploying right now in companies from pre-seed through Series B. And we are also gearing up to raise our next fund.
Hey guys, my name's Aryan. I'm with CMT Digital. We are a blockchain venture firm. We're currently on Fund 4. This one's a $136 million vehicle. We like to invest early stage at the kind of pre-seed, seed, Series A stages. We're series agnostic in terms of, sector agnostic in terms of what we look at. We're generalists across blockchain, but really looking for use cases of blockchain that result in some net new activity or some net new efficiency gain that wasn't possible before. So it's not really limited to just, cryptocurrencies. Pleasure to talk today, and thank you for having me, MetaLayer.
Awesome, thank you. So I think, as you guys heard in the intro, the title of this panel was originally going to be, are VCs even investing in this market? So the four of us I know are all actively deploying capital, but I think that is the sentiment that a lot of founders are feeling right now. So I'm curious to hear from the three of you, generally kind of what are you seeing in your investment committees? Kind of like what is the vibe right now? What kind of deals are getting done? Is the bar higher than it's been historically? I think that's probably a good place to jump off.
Go for it.
I can kick things off. We certainly still are deploying. I think it's not so much that the bar is higher. I think we're more aware of what sort of key indicators to look for when we're looking at these deals. Because we're in an environment where it's no longer just the momentum or the potential, but it's actually what they're doing today and what sort of partnerships they have in place today and what sort of needs are they fulfilling today. And I think the stage that crypto is in at today allows for those efficiency gains to be observed and to be acknowledged. And I think that is a fortunate position to be in because we haven't had that luxury in cycles past. And that's something that's been keeping us excited amidst this broader market downturn.
Yeah, and to add to that, I think when we do ICs today and compare it to maybe like during the election cycle, right? The market is completely different in terms of how fast the deals get done, which allows us to spend more time with founders and understand their product more intrinsically, look at the data, right? And I think also when you look at the altcoin markets, right? Like the companies that are doing well are the ones that have a fundamental business plan that sort of is effectively, in a way, uncorrelated with sort of how the sentiment is, right? Like when you look at a company, I think Grass is a great example, right? Like when you look at their token, it's trading down, but when you look at the company on the equity side of things, they're growing their revenue month on month crazily. There's companies like Rain, right, which is very popular among crypto neobanks, right? That they offer cards. Again, it's not a company that you see. They don't have a token, but it's a company that again is also growing very, very well. So like, I think there's a disconnect between what's happening in the sort of if you go on CoinMarketCap versus what's sort of happening underneath in these different I guess levels of where the industry is at. And I think when to us it's good in one sense because we're looking at more at the fundamentals of a company, and I think this is something that we can also touch upon later, right? It makes it harder to build a company when you have to actually prove that the business works, right? I think in the past, like you had a great idea and then people would fund it because it was exciting and new, and now we sort of see that it can't just be exciting and new. There has to be some fundamental business logic that allows it to survive through these cycles, right? Because in the end, that is the most important thing is just to survive. I think that's a great feat already. But yeah, so like coming back to the ICs, like we just have more time to spend with the founders and really understand where the business is going. And it makes our job a little bit more interesting because yeah, it's just you get to evaluate the core business here and then see where the outcome is at. Yeah.
Yeah, I feel like there are two different dichotomies that we're seeing play out in the market. One is on the VC side and one is on the crypto side. So on the VC side, we're seeing the rich get richer. So the mega funds or the mega firms are raising larger and larger funds, and the industry is consolidating around them with more LP capital going towards them. As opposed to emerging managers and smaller funds. And so there are fewer VCs deploying, and those VCs have a lot of capital to deploy. And so they are typically investing large checks into rounds at inflated valuations. And on the crypto side, we're seeing this dichotomy between institutional capital flowing into the space and on the other extreme, crypto native folks saying that crypto is dead, which I don't think it is. But we're seeing some founders and VCs kind of get squeezed on both sides, on the VC side and on the crypto side, where token projects right now are not getting as funded, and where equity deals are receiving the majority of the capital. I do think that will change, as we've seen with past cycles, but that's where things are currently.
Awesome, thank you for that. So part of what I really respect about the three firms on stage, Maven 11, HiveMind, and CMT, is that they are very institutionally trained and professional asset managers. So I know there are a lot of aspiring entrepreneurs and founders in this room. I think it'd be really helpful to talk about kind of what you're looking for in founders, in teams. At least within our IC, we spend a lot of time talking about founder market fit. Kind of what has this entrepreneur, what right have they earned to kind of win within this market? So I'm curious to hear the advice you would have for founders when it comes to kind of building that credibility and that founder market fit. Kind of what are the steps you can take? What are you looking for in founders?
I mean, from our perspective, it's a multifaceted thing that we're looking at. of course, founder market fit is important, but I don't think it's necessarily disqualifying for a founder if they don't have extensive experience, 10 years of building and an exit in their given field. I think the most important thing for us is really scrappiness and the ability to move into opportunities that they spot. Especially in crypto, there can be products that look largely the same from a technical perspective, but one is successful and one is not. And if you look through the reasons why that has been the case, maybe some bridges, or look at very comparable products and where one has succeeded and one hasn't. It's been purely that go-to-market opportunity that one has been able to execute on while the other hasn't. If you spot an opportunity in a market and you're worried, is this going to be seen as a pivot? It's that sort of decision making that I think differentiates a good founder from a great founder. Being able to spot those opportunities, move into them quickly, have the conviction in themselves, and also be able to say, okay, maybe this isn't going the way that I thought it was going to, and move away before it's too late.
Yeah, maybe to add to that, like we also look at the same thing, scrappiness, but it's also drive, right? I mean, when we look at these companies, I think in the past it's sort of the sort of motto was build and they shall come, and I think that was very true in the beginning when there was maybe like 10 DeFi protocols out there, or 10 chains, right? I mean, but now there's hundreds of chains and 1,000 DeFi protocols, and so like you're from a founder point of view, like you do have to be able to sell what you're building, right? Like you can't just rely on sort of the market finding you, or like, you know, doing some tweets. Like there actually has to be, and this is something we really focus on, like your ability to market your product in a way that you can get to your target audience, get to your clients. I mean, this obviously depends a lot on what you're doing, right? If you're a DeFi protocol and you're targeting retail, like can you communicate your product in a way that people understand, oh, this is why I should be depositing here versus other place? Like, what is the risk that I'm taking? Like these communication of the product is so crucial, and making sure that you attract the right people on board. And I think that's often overlooked. And in the end, like we're doing sales, and in the end, it's a little bit sad when you think about it, because of course a lot of you guys are great engineers and great minds, like, and you just want to build the perfect product, but it doesn't really matter if no one is using it, right? And then so that is a missing step that's super important and often gets overlooked. And yeah, it's a bit related to sort of the grittiness of a founder, being like perseverant and understanding what the actual product is on the eye of their customers. And I think, yeah, for us, that's a really, really important part in our decision process.
Yeah, echoing what the other panelists have said, for us, we do look for deep domain expertise in a founder. That doesn't mean that the founder needs to have founded a company in the past and or exited that company, but the product that they're building and the target audience that they're looking to sell that product to should feel authentic to their expertise and past experience. And we put a lot of emphasis on the go-to-market. So has the team really thought through the go-to-market strategy? Have they already tested that go-to-market, even if the company is at kind of the earliest stages and this is the first round that they're raising? Have they done the necessary customer discovery and have they actually had conversations with the people that in the future they will look to sell to validate what they're building and to see if there is initial product market fit and demand among that audience?
Just one thing I want to add, because on our investment memo, we have 5 different categories relating to a founder. And this is, you know, probably shouldn't be saying this, but it's free advice. And we've covered 4 of the categories. The only one that hasn't been mentioned is talent magnetism. So what sort of talent does that founder attract to the company? Especially when we're investing so early, that's something that I think, you know, carries throughout the life cycle of that company and is something important to focus on too.
Thank you. That's really great. Some inside baseball into how VCs think about evaluating founders and teams. So sticking on the general topic of advice and kind of how to successfully run a fundraise process. I'll ask two questions, maybe the negative version and the positive version. So the negative would be, what mistakes are you seeing founders make right now? Like, how is the market and the playbook in 2026 different versus past cycles, 2021 and 2024? We've seen this a handful of times, teams kind of putting together party rounds, no strong institutional leads, and then approaching firms like the ones above, kind of in trying to structure an opportunity or a lead and seeing it kind of not go well. So I'm curious if there are common mistakes or pitfalls you're seeing teams make. And then the flip side of that would be, what kind of other strategic or tactical advice would you have for founders kicking off a fundraise? Would you say kind of if they don't tick all of those boxes we were talking about earlier, should they potentially be waiting for better market conditions, or should they be out there kind of grinding it out, trying to put together a round? So tell us a little bit more about mistakes or advice you would have for teams going out in this market.
I mean, it really depends. There's many levels to a mistake, I guess. But like, I think one thing that we see often, and especially if you're entering like a market that already exists and is sort of competitive, it's showing how you're different, right? Like, I mean, I've looked at 30 different prediction markets. They all look the same, right? Like, and the concept is the same. Like, understanding what is the difference, and why is it so significant that you can challenge these incumbents, and why, like, how does that sort of translate again to your user base? How does that translate to why the tech is better, and why, like, just that communication is like very, very important, because I guess because it's like from the VC perspective, like, you see many deals, and then I have to spend, I need to be very, it has to pop in front of me very clearly why you win, like, why are you different, why is this a good deal for me? And I think the communication there is sort of what often founders get wrong, and I think the way to solve for this is you should talk to your friends in the industry, or if you have VC friends as well, to sort of get feedback before you do pitches, right? Because these are easy mistakes, because you probably already have a good answer to it, or some pretty decent answer, and it's about sort of making sure that it's front and center whenever you enter a conversation, specifically when you're already sort of working in this, like, more of a crowded sector, I would say. If you're obviously a very differentiated product that no one's built before, then I think the conversation's a little bit different, and it's about sort of really explaining in layman terms, or if the VC is very technical and it sort of fits the bill, then again, why is this important, right? Yeah.
One mistake that I've been seeing a lot in the current market is founders not prioritizing and taking a more active approach to fundraising. So I've seen a lot of founders taking calls here and there, but letting their runway get below 6 months because they have not been super proactive about running a tight process. And once you get to that point where you have less than 6 months of runway, it kind of shows in pitches, because you look a little bit more desperate, and you can't be as selective and strategic about who you take money from, and that's really important. And so my advice would be to start early, give yourself plenty of time to put together a good process, and then run a really tight process. So once you're at maybe, let's say, 9 months out, maybe even earlier than that, 9 to 12 months, start having some initial informal first conversations with VCs, just to start putting feelers out there. But don't take first calls after that until you're actually ready to kick off your process. And at that point, come prepared with a full data room. I personally really like to see a well-written, thorough investment memo that summarizes for VCs basically why they should invest. It gives you, as a founder, an opportunity to basically write them an essay persuading them to invest in your company. And so putting those details together makes it really easy for a VC to do their job and get to a yes. And then alongside that, put together like an investor wish list, so a list of well-researched investors that make sense and align with your company's focus, and run a tight process, ideally in a couple of weeks. Sometimes these stretch out over a month, but run a tight process where you are having back-to-back calls with VCs, doing first calls, then a couple weeks later doing second and third calls, and getting to the IC process where you're building a lot of momentum and some FOMO and hype among VCs so that you can get your round closed quickly.
The biggest mistake that I think founders are making right now is going to sound somewhat unintuitive or even wrong. I think some founders are focusing too much on product. And what I mean by that is, so I'm the head of research at my firm, so I'm looking at the technicals a lot, and I care about the technicals a lot. But rarely does the market care about the technicals nearly as much as I do. And it's really easy as a founder to want to optimize every single part of your product to the maximum. But if that means you neglect the right to win in taking that product to the market, it doesn't matter. And so I think not neglecting a very specific strategy for taking that product to market, for putting it in front of the users in a way that it's really beneficial for them to use your product over another. I think stablecoins is a great example of this. There's so many different stablecoin management products that can apply to any institution, but why should they use yours? Do you give them netting, for example? Do you give them some sort of capital efficiency beyond just stablecoins? I think those sort of product details really matter, and if you can align them with the go-to-market, it puts you in a much stronger position.
Just one final point that I also wanted to mention is this is more on sort of when you're doing a round and you're talking to a few VCs, right? And then it's understanding what you can tell another VC in terms of like, do you have any commitments or anything like that? Like, I think it's pretty obvious thing, but don't lie, right? I think this is often what happens is like VCs, we all talk to each other, right? We're friends, right? Like so when I get a deal and I'm interested, and I know Kayla sort of also looks into a similar thing, and you tell me, hey, we're talking to Hivemind, it looks like they're going to invest, whatever. You're trying to get me to FOMO, and then I check in with her, and she's like, yeah, we just had one chat. I don't know, like it's a bad look, right? And I think it's a pretty obvious thing that I'm saying, but it happens more often than you think. And I think the point here that I'm trying to make is like you don't have to oversell yourself or overpromise or try to over-deliver. I mean, I think maybe this is a little bit of the European in me. Just give me the facts. Like I'll judge you by what I see, right? Like, and if you overpromise or if you say things, I'm gonna go check them, right? That's my job. I have to underwrite you guys, and so that is yeah something we see, and it often sours the deal for us, and we've passed on a couple of deals because of that. So just again,
awesome. Well, really appreciate it. All super tactical advice. So 2 minutes left. Maybe we can do a little bit of a round robin, just 30, 45 seconds each. I'd love to hear some of the markets or categories you're most excited about. So maybe we can just go down the line.
Yeah, I mean, from our perspective, we really like the intersection of TradFi and DeFi rails today. The opportunities that allow TradFi liquidity to move into DeFi environments, we think will provide a primer for some of the larger scale open source, open network type opportunities that exist within DeFi. They become far more viable once there's a larger liquidity base to support them. Also excited about Deepin, where they can kind of offload essentially capital spend from legacy providers. Telium He-Mobile is a great example of that. Those types of partnerships for outsourcing capital expenditure to a more unit economic efficient, medium, I think is something that we're excited about too.
Yeah, we're looking at similar areas. So also focusing on market infrastructure and especially institutional infrastructure within that bridges the gap between TradFi and DeFi. Another area that we've been focused on is AI infrastructure, thinking about hardware and software acceleration and other areas too, including heterogeneous compute and speculative decoding.
I think from our end, we've also sort of trended towards this direction of looking into sort of the intersection between DeFi and, well, TradFi, I guess. But I don't think we are sort of that's our core focus in any way. Like, it is my focus. That's sort of what I'm very interested in, the credit space. But at the same time, I think fundamentally what we want to invest in are good businesses, and that can be any flavor, right? Like, I think we've sort of realized that the industry is shifting more towards like like fintechs, just because of what sort of blockchains are very useful for in the finance world, like stablecoin transactions and everything. It's just a great PMF for the technology, and so we do see ourselves sort of going more in that direction. But we also are looking at traditional sort of SaaS companies that are very much crypto adjacent or very much sort of in this space. But yeah, I don't want to shoehorn us as a fund into like a specific category, but yeah, we look at everything, and we're interested to talk to everything, and then it's more of a question: is it a good business? Then we'll invest, and if it's not, then yeah, I guess.
Okay, great. Well, how about a round of applause for our three great panelists? We really appreciate you taking the time to be here.